You're watching the Dinar Chronicle, your trusted source for breaking updates on currency shifts, global monetary policy moves, and revaluation news that matters. Today's alert is one you cannot afford to ignore. Just hours ago, the Vietnamese Dong broke through a long-standing resistance point in global Forex trading. A move analysts are calling a potential spark for the next RV wave. With rate movements, central bank whispers, and financial institutions reacting across Southeast Asia and beyond, what we're witnessing may be more than just a fluctuation. It could be the first domino in a much broader reset. Let's break this down in full detail. In early trading today, the Vietnamese Dong pushed past a technical barrier that had held for nearly 3 fiscal quarters. This resistance level, which hovered around 23,200 VND per USD, had served as a ceiling for institutional investors, currency managers, and Forex speculators. When the Dong surged past this point in the 3 a.m. Greenwich Mean Time session, algorithms across global trading platforms began triggering auto-buy orders. By the time New York markets opened, VND had firmed its position nearly 0.6% higher than its 30-day average, marking one of the most aggressive upward corrections the currency has seen since mid-2020. The shock? Not just in movement, but in timing. This move coincides with a series of quiet but significant developments across Vietnam's central banking framework. Earlier this week, the State Bank of Vietnam completed a months-long pilot of its digital settlement platform in partnership with Asian regional clearinghouses. While the official announcement was framed in generic modernization language, currency watchers knew better. Such technological rollouts rarely exist in isolation. They precede capital controls adjustments, reserves balancing, and, more often than not, rate recalibrations. This morning's movement, therefore, isn't being viewed as an accident or a one-off reaction. It's part of a much deeper realignment. Now, let's connect that to broader market sentiment. Over the last 18 months, we've seen Vietnam gradually reduce its dependence on dollar-based trade settlements, a trend echoed by ASEAN trade bloc partners and even bilateral talks with BRICS plus aligned countries. While not overtly signaling de-dollarization, Vietnam's diversification of reserves into yuan, gold, and select SDR-aligned baskets has caught the attention of the International Monetary Fund and the Asian Development Bank. According to reports shared with regional finance ministers in Hanoi last month, Vietnam now holds less than 72% of its strategic reserves in USD, down from 83% 2 years ago. That drop is substantial. And for those watching for clues of an intentional rate reset, it is highly telling. What makes today's Dong movement particularly striking is the synchronous activity in adjacent currencies, including the Indonesian rupiah and Thai baht. While neither showed the same spike, both exhibited micro-adjustments consistent with regional monetary coordination. Sources close to Singaporean clearinghouses noted unusually high overnight swap activity involving VND pairs, particularly with the Korean won and the Chinese yuan. This has led several financial journalists in Asia to speculate that backdoor currency synchronization mechanisms may now be active, something we've seen before in the weeks leading up to rate events. Adding to the urgency, unconfirmed reports suggest that at least 2 Tier 1 foreign banks operating in Ho Chi Minh City have updated their internal foreign exchange rate sheets for the VND against the dollar and euro. While those rate adjustments are not yet public-facing, multiple customers reported discrepancies between live market rates and what appeared during in-branch rate queries. Some speculate that these banks are preparing for soft screen testing, a phase that typically occurs days or weeks before new rates are formally issued. If that holds true, then we may be closer to a tangible revaluation event than previously forecasted. Another key indicator to consider is foreign capital inflow. Vietnam's bond market saw a surprising spike in foreign investor interest this past week, with more than $2.1 billion flowing into 3- and 5-year sovereign notes. This marked a 19% increase over the prior week's issuance and the highest weekly total since April 2021. Analysts at Barclays Singapore attribute this activity to speculative bets on the Dong's upward trajectory, driven by signs of structural policy change. The larger picture shows Vietnam strengthening its domestic credit system, tightening monetary policy, and reinforcing foreign asset reporting requirements, all moves historically linked to macroeconomic readiness for valuation change. Meanwhile, Forex analysts in London and Frankfurt are beginning to revise their positions on the VND. Earlier this month, JP Morgan revised its 12-month outlook for the Dong, stating that it no longer considers the VND a pure soft peg currency, but rather a managed appreciation asset with revaluation risk. That language, rarely used in major bank forecasts, suggests the VND is now perceived as a serious candidate for official rate adjustment. Morgan Stanley and Credit Suisse both echoed similar sentiments, with new risk models pricing a 1.8% to 2.4% upside movement in Q3. The question on everyone's mind now: could this movement catalyze the long-speculated RV wave? While some economists remain skeptical, others point to the convergence of technical, political, and institutional signals. Frank, 26, a prominent voice in the revaluation space, commented in his Tuesday live broadcast that Vietnam is now executing the kind of quiet confidence move we saw from Iraq right before their Article 8 positioning. That comparison is meaningful. Iraq's shift into Article 8 of the IMF Charter marked the beginning of currency liberalization and set the stage for revaluation. If Vietnam is heading toward a similar IMF milestone, or is already receiving shadow consultation on rate liberalization, then today's move may only be the first of several dominoes. Complicating matters, U.S. Treasury officials recently included Vietnam in its semi-annual review of potentially undervalued currencies due to its significant bilateral trade surplus with the United States. While no formal manipulation designation was issued, the review hinted at upcoming dialogue with Vietnamese monetary authorities. In past revaluation cycles, such language from the U.S. has preceded restructured trade settlements, policy reform, and, in some cases, rate changes designed to appease trade friction. This has led some to believe that coordinated diplomacy is at play behind the scenes. Simultaneously, Vietnam has begun to implement Phase 1 testing of blockchain-based settlement layers for domestic interbank transactions. While this rollout has flown under the radar, technologists at the Bank for International Settlements have reportedly provided technical consultation, further fueling speculation that Vietnam is preparing for a hybridized currency model, one that allows both fiat settlement and digital transactional layering. Such a model would be ideal for absorbing a sudden surge in transaction volume, a typical hallmark of a currency revaluation event. We're also hearing growing chatter about redemption protocol trials. While nothing has been officially announced, several private exchangers and wealth managers claim they have been briefed on new VND redemption processes. Some of these updates reportedly include tiered access rates, biometric identity confirmation, and time-restricted redemption windows. If accurate, these features mirror protocols used during rate window activations in the Gulf states during past valuation cycles. If Vietnam is moving in that direction, then it signals a high level of orchestration at the policy level. The market itself is reacting. Currency exchanges across Southeast Asia, particularly in Malaysia,